Let's talk about loan against shares and F&O because, that's caught the attention of a lot of people in their 20s and 30s where they do have the overconfidence to be able to believe that they will be the exception again, right?
Yeah.
And clearly you also lived through that cycle. I've never been into F&O, so I'm not I don't have any active experience there, but would love to learn from your experience.
So in 2003, 4, I think around that time, I used to get again hyper overconfident and would borrow money and wanted to get rich faster. I got poorer faster because of that. Mm. So, all kinds of crazy things happen, elections and, India, bad election, I mean, unexpected election results in the market, shutdowns, big shutdown of markets. And margin calls, and basically you realize that you don't have the capacity, and all those stocks went back. It's not like I was not buying good businesses. I was buying good businesses at good prices, but I didn't have the capacity to stay invested in those things because I had borrowed money. So there was a margin call, and I didn't have the liquidity to pay for that margin call. So the broker would sell my shares.
Yeah.
I was forced seller in a down market. So and after 4 days, the stock went up way above the price, and it was taken away from me. So that teaches you that you have an asset liability mismatch. You have a short term liability, and you financed it with for a long term asset. It's not. It's what brought down LTCM. It's what brought down so many other businesses. You learn about that later on, much later on.
Yeah. Professor, you often cite the work of Daniel Kahneman and also talk about behavioral finance a lot in your teachings. What's a personal bias that you have personally struggled with?
Well, when I do a post-mortem of decisions that I was clearly wrong on, I have found that the corrective action that I took, I was too slow to have taken the corrective action. And again, the reasons are behavioral. There's always the commitment bias, falling in love with the ideas, going into denial mode, and there's always noise. There's information coming in. You want to give them more leeway. There's some information about the performance of the business. The moat is getting eroded. There's a governance issue. You might think this is the one-off thing. Don't think too much about it. But I should have been more brutal about it, and I should have been more objective about it. Absolutely. I did take the right decision eventually, but I should have been quicker about it. So in the sense that, as I said earlier, that the market is a Bayesian, no doubt about it. The market will come to the right conclusion in the long run, but it takes too long. Even I would like to be a Bayesian, but the way Thomas Bayes would have liked it to be. So he actually tells you that there is a process, but in some cases you should change your mind very, very quickly. So he gives an example. So again, it gets a little technical, so we'll leave the technicalities, but there is a process that he tells you that in some situations you change your mind very, very quickly. In some cases you change your mind very slowly. So I found that there have been certain developments in some situations where I was holding on to a situation where I should have exited very, very quickly, but I did not. I took time to do that. Maybe a few quarters. I should have done it maybe in a few days. So that's the mistake that I need to work more on.
Has it changed now?
It is. It's definitely got better, but there is still scope for improvement. There'll always be some scope for, and to be sure, there will be new ways of making more mistakes.
Yeah.
And there's no such thing as a perfect, rational investor, I think.
That's what makes life a fun ride also.
Yeah.